Tonight we're asking a bold and deceptively simple question. How can finance be harnessed for good? Finance is the bloodstream of the economy that determines what gets built, who gets backed, and which ideas have a chance to grow. It has the power to amplify progress or entrench disadvantage. At its best, finance fuels innovation, supports livelihoods, and spreads opportunity. At its worst, it concentrates wealth, extracts value, and accelerates exclusion. And yet, too often, finance is treated like a technical issue, complex, opaque, or even unapproachable. But it is deeply social and inherently human. How we structure markets, how we price risk, who we choose to lend to or invest in, these are not simply economic decisions. Tonight, we're here to open up the conversation, to bring together academics, investors, entrepreneurs, policymakers, and you, our participants, to rethink how finance can be harnessed for good. We're especially focusing tonight on fintech, not because we believe technology is a silver bullet, but because it's a powerful lever. Used well, technology can lower barriers, increase transparency, and expand access to those historically excluded from financial systems. But it also carries new risks like bias, opacity, fragility, and that's why trust is central to this conversation. So tonight we'll explore both big picture and more tactical insights and interventions in two blocks of conversation. Our dialogue design, if you will. So tonight, we'll first talk about big ideas, how finance can be reimagined to align with broader social goals. Then we'll go deeper into the tools, models, and technologies that might help us get there. You'll hear from 5 outstanding panelists with industry, academic, investing, and regulatory experience, each bringing a different perspective to the questions. Now let's begin with some quick introductions. First of all, we have Professor Raghavendra Rau, or if we may, we'll call you Raghu tonight, if that's okay. Known to his friends and colleagues as Raghu. Professor Rau is a Sir Evelyn de Rothschild Professor of Finance at Cambridge Judge Business School, a holder of distinguished chairs at Gresham College and the University of Valais. He is the incoming president of the Financial Management Association and past leader of both the European Finance Association and Financial Management Journal. Professor Rau also founded the Cambridge Centre for Alternative Finance and serves on multiple leading journal editorial boards. Next to Raghu is Dr. Chanelle Duley, a lecturer in economics at the University of Auckland Business School. Chanelle's research covers issues around globalization and the movement of goods and people, as well as how the financial system is evolving. Chanelle studies cryptocurrencies, especially stablecoins, and cybersecurity and banking. She has worked with various central banks in and beyond New Zealand, including Canada, Germany, and BIS on crypto services and central bank digital currencies. Next, we have Decio Nascimento, the founder and chief investment officer of Bilberry Partners, where he leads an investment strategy that blends macro analysis with sustainability. He also serves as chief intelligence officer at 60i and was previously CIR at Richmond Global Compass, pioneering early integration of sustainability into multi-asset investing. Decio holds an MBA from Yale, where he guest lectures and is active across several advisory boards and leadership councils. Next up, we have Becki Butler, the co-CEO of Caps Traders, and is known for her commitment to seeing business embrace regenerative capitalism to solve the complex problems that the world faces, intersecting positive social impact with competitive advantage and higher market capitalization. More specifically, Tax Traders is a purpose-driven digital services provider offering a smarter, more streamlined way to manage professional tax payments, and it is recognized in the top 5% of B Corps worldwide for ethics, accountability, and transparency. And finally, we have Christopher Swasbrook, or 40 May. We'll call you Chris tonight. All right.
The least qualified person to
Not at all, and in no order of importance at all, Chris. Thank you. Is the founder and director of Valuation Capital and co-founder of the NZX-listed New Zealand Rural Land Company. He chairs the Open Future Fund and serves on the board of the Financial Markets Authority, following a career that included senior roles at Goldman Sachs, JB Were, and multiple NZX-listed companies. A long-standing figure in New Zealand's capital markets ecosystem, Chris currently serves as a board member of the FMA, having previously served as a member of the NZX Listing Subcommittee and a member of the New Zealand Markets Disciplinary Tribunal. So we are in very good hands indeed. And I have very much enjoyed getting to know them a little bit before now. But why don't you welcome, please, our panel tonight. Now, if I may, we're going to tackle this very first big picture question, please. And again, I'll invite you to log into Slido if you haven't already. So I'll give you a moment to capture that on your phone, or you can go to slido.com and use the hashtag Juncture to find the interactive app or website where you can start posing your questions. But to kick us off, can I just start with you, please, Raghu, if I may? Not because you're right next to me, but because I think this lends itself nicely to your expertise. Is there a useful way to think about finance that helps us make sense of both its power and its risks? What lens should we be using if we want to use it for good? How can we perhaps distill down some of this complexity as the very first part of our conversation? Or frameworks. Any good educator loves the framework.
Yeah, I'm very good at laying out frameworks. I'm less good at practically implementing those frameworks at bones analysts here. But the way I think about finance is, at the end of the day, it's a very simple question. How do I move money across time? So essentially, the simplest financial transaction you can think of is, I need money now, so I borrow the money and I will repay that money in the future, possibly with interest, possibly with another stake, something like that. But that very simple transaction has a whole bunch of complicated things around it. For example, one person you might be interested in borrowing money from is yourself in the future. Right now, you're young, so you don't have money, so you need to borrow money. But when you're old, you will have money, so you need to somehow channel the money back to yourself when you're young. Now, none of us have a time machine, as far as I'm aware. But there are other people who are at different stages in their life at that time. So what you do is you borrow money from these people and you repay them when you become older and you have the money. However, in that transaction, you need to think about now liquidity. Are there enough people right now who will lend me the money so that I can repay the other people in the future? Which in turn goes into things like pensions, pension funds and pensions. Will there be enough? So I'm young right now. I may be paying money in taxes to support people whom I don't know so that they get money out. But will there be enough young people to support me when I get it? There is still money transferring across time, but it's also about liquidity in those markets. And even more interesting, you can go backwards. For example, maybe you extracted resources from people, like you think about a colonials, and lots of people here are aware of that. So you go back into the past, you extracted resources in the past. What do you owe those people in the future? So you have taken money from them. Do you need to pay them back? Are you responsible for this? And then the question also becomes, at the end of the day, who is responsible? Are we as a society responsible? Are we individuals responsible? All these is a very simple framework. I'm still moving money across time, but I go backwards and forwards and across people. That's the essence of finance.
All right. So if we focus on perhaps that transfer of or moving of capital across time, and perhaps Chris, I can ask you, with your experience and expertise, if finance is about moving capital to where it's needed, who should be in charge of that transfer? Is it the job of private markets, government, or someone else? In your experience, what do you think works best?
Is to provide railway tracks, right? And that's what Prasanna and I, when we're thinking about the FMA, we provide railway tracks. And if you fall off the railway tracks, we should hit you really hard, right? Because we've provided. But when you think about pretty much inside the railway tracks, you want government to get out of the way, because the private sector has proven over time that it is very efficient at solving problems. But you need to provide the railway tracks. And the railway tracks just not about regulation of when people break some rules. The railway tracks also encompass that you have to have a strong social safety net inside there and have social considerations for those that are less fortunate. And that's something that we need to think more of into the future, with the divide, the haves and the have-nots, and this transfer of money over time. What does that look like? Because to come to your point, we're facing massive deficits in that movement of money over time. It's been very favorable if you've been born after 45, up until the 1970s, right? There's been a favorable shift of money across generations. Now we're facing massive funding gaps. Budget touched on that today here. Fortunately, New Zealand's in a better fiscal position than most, but has its own challenges, being an island nation with on fault lines and remote. So coming back, I mean, I think we need the strong railway tracks of regulation to provide the framework, and where we have been weak, and I think on that is we don't actually hit them hard enough when they fall off the railway tracks. Sarah and I talk about this all the time. You need to go harder when people actually steal up other people. We should really hit them hard to discourage that behaviour. And we should let the private sector, like smart companies like tax traders, who provide people with mechanisms to move capital, to fund liabilities, and take advantage of other people's capital, we should encourage them to do it. The government was never going to come up with a tax funding mechanism. They just want to take the money.
Perfect. Well, perhaps I'll circle back to you, Becki, if I may, to talk a little bit more about the porgy end of finance, what you're working. But I'd like to go to Chanelle at this point. So we're talking about who controls the flow of capital, or when we talk about who controls the flow of capital. How do things like digital currency and decentralized finance change that picture? Is it an experiment gone wrong, perhaps, or does it open things up, or just shift that power somewhere else?
Thanks, Stu, and thanks to Susan and Jason for a great opening tonight. I'm very glad that Raghu spoke about the movement of capital among people in November time, because I think a lot of the impetus for why we're all here today is that we notice that capital is highly concentrated and there's a lot of discrepancy in who holds these resources over time and across different cross-sections. And I think the decentralized finance example is a great one because it offered us an opportunity to kind of reset everything. It was a brand new financial landscape that evolved almost from nothing, from Satoshi Nakamoto's paper that launched a whole series of entrepreneurs and innovators. And so in theory, we were all starting off at an unequal meeting. In many cases, yes, that's the case. But what we observed there, and I think that speaks to finance more generally, is how very small asymmetries to begin with, when people start off on very slight different footing and runs of luck, can lead to vast discrepancies in the concentration of these resources over time. And what I want to highlight is that's not always necessarily a bad thing. I mean, there are many benefits to pooling resources, agglomeration effects, network benefits that sometimes can be a good thing. But I think we need strong regulation by technically competent people who can distinguish between the good concentration and the harmful concentration.
Do you think, to follow up on that, Chanelle, that, to use Chris's analogy of the railroad tracks, that's being effectively done at the moment with in this ecosystem that you're describing, or is there more work to be done?
Yeah, well, I would say again, the FMA is doing a fantastic job in what we I mean, in the traditional financial market, yes. I think the decentralized financial market, or some of these new innovations that are coming along, sometimes need the same regulatory toolkits, and in some cases need slightly different ways of thinking about these things. So I think that has a long way to go. But on the point of regulation, what I'd like to say, in addition to what Chris was saying in terms of the stick approach and preventing moral hazard, keeping people in line, is also the important role that regulation plays in financial markets as a coordinating machine. So regulation is very useful at orchestrating a financial system, because when finance relies a lot on coordination across people. So I'm more likely to trust a currency if you trust it and all of you trust it. So regulation also serves an important social purpose at helping people work cohesively and restoring confidence in the system.
So the regulation, in fact, can sometimes serve as a proxy for trust. So trust the system. Very good.
But also that I happily worry about the fact that, sometimes the people whom you're laying the track for are also telling you what direction the track should go. That's what I was just about to say. I mean, come on. Crypto regulation is essentially non-existent. The president just removed Gary Gensler, who was talk tough on crypto, but actually actions were pretty light when you look at it, and replaced Gensler with a guy that is pro crypto, and there is largely no crypto regulation to speak of in America now. It is a free for all. And that is a major problem for other regulators around the world when your major market of an asset class is basically lawless, and your president is a major player in crypto. Let's not even go there. We're stretching a metaphor out to having a train and a conductor as well. The grip.
Yeah, that's right.
Springs to mind.
Well, let me circle back to you, please, Becki, because Chris has alluded to some of your work already, but most certainly sort of at the pointy end of finance. So you're building tools with much success that people actually use. So in your view, again, in more of a big picture view, what's missing in how we talk about finance as a force for good? This can sometimes sound a bit esoteric or nebulous even. What's your experience showing you in terms of finance as a force for good?
Yeah, good question. I think there are probably, I could give you a whole list of reasons.
Yeah, very well. And the plywood all is out. This is good as already.
Yeah, I should be a paper for everything. So here we are. I'll probably hone in on two particular things that come to mind for me. I think one of the things that is missing in fintech that would take a close to being force for good is the concept of dignity as a design principle. So designing from the outset with the dignity of the user and the communities in mind. And that would help us to ensure that outcomes are fair, are human-centered, and are having good social impacts. And I guess aligned with that is starting with purpose at the heart rather than just profit in isolation. Those two things actually go beautifully together, but sometimes the purpose aspect is missing. And if you start with purpose at the core, actually all of the onward decisions and choices and directions really become very, very obvious. It would lead us, for example, to rebalance the power dynamic that exists in finance. For a long time, it has been designed by people who are already in that space and who will benefit from being in that space. But to truly serve the people on the planet, we really need to move away from that into a place where people who had typically been excluded or underserved are actually brought into the room, and we are co-creating fintech products with people, not for people. I think those are probably two really key differences that I would say, and that will help us also bring a lot more equity into the distribution of capital. I think we need to stop saying in fintech, what can we build, and actually start asking ourselves, who is this really serving and who are we leaving behind when we build in this way? Those are pretty powerful questions, I think. Your really purpose would lead us to a place where we have governance and approach that will put people before algorithms, will put transparency for speed, and would put trust before profits. It would guide us to build trust into the architecture from the outset instead of bolting it on at the end as a little add-on or from a sandpit. The end.
And you're doing this with H-Phrase, and we'll get to hear a little bit more about what that looks like out in the second block. So
I'll be passing the talking stick too.
Oh, to Decio, who's next? So again, Decio, you've worked at this perhaps intersection for some time now, and again, enjoying some success in that intersection between sort of fintech and impact. And Becki alluded to it already, but what do you think the key to making sure the fast-moving innovation still delivers those long-term social outcomes? Does it just chase that short-term growth? What or how are you seeing this work best in your experience?
I think it goes back to a little bit what Chris said, the real tracks, and a little bit what Professor Raghu said before the lecture, where he was talking about externalities. I was just listening. And it in the end of the day, that's where rules and regulations are important, is where business create externalities. So the government is to step in to either internalize those externalities or to in some way prohibit those externalities. And the good thing about, I would say, not just fintech, tech in general, is that with the level of communication we have today, right? If you think about how the world, people were learning the mass was learning how to read and write maybe 200 years ago, going to university maybe 100 years ago. They're going to be past 30 or so. You have everything at your fingertips and more and more power up. So I haven't seen it. This is one thing I'm always curious is about how this technology can help improve those rules and regulations, how the technology can improve your position in democracy, right? This idea of representative democracy evolved because you have so much people, right? You can be like Asian Greece democracy and try to solve for that. But now, and that's why you ended up to doing that. And it's a whole different story of how that got hijacked. But nowadays, why do you need so much of that, right? And why can those rules and regulations be maybe using blockchain, maybe using different kinds of technology, a way where the people can balance each other and make sure that those rules and regulations are not going into a specific direction, because then you're going to have push and pull. So long story short, as an economist, I would say internalizing externalities is, that technology can do that, is a good way to keep purpose and profits aligned, right? If you, for example, markets in general, right, had rules and regulations. This idea in the U.S., at least, where in the past 50 years, where live the market itself and we don't need any rules and regulations, is very misguided. You're just not seeing the rules and regulation, right? So if that was true, there would be a market for artists. There's no market for artists, right? Because that's not the best way to hold it. So anyway, in a sum, I think it's not just fintech, but tech in general can help a lot. Aiming those rules and regulations in a way where you can internalize those externalities, and you will solve a lot for what society needs.
Or if it's some wrestling with some tensions, which is good. And I still like the railroad tracks analogy. Chris, thank you very much. But what we're going to do now, please, as noted in the introduction, we're going to take a moment for you all to, at your tables, digest a little bit of what was discussed and talk with each other about, of course, any of the content, but one perhaps conversation starter that we've posed for you to initiate this conversation. And we'll give you 5 minutes, and you are on the clock, to consider your questions for the panel, is to note them please in the app as instructed. And please do, if you wish, direct your question to one of the panelists. And we'll have an opportunity to iterate between us and the panelists in response to your question. So take 5 minutes, talk with each other, and then we'll kick off a discussion around these big picture sorts of themes, please. But nonetheless, we will now have opportunity to hear from some of the panelists. We've seen some questions coming in. Thematically, some are very similar. So what I might do is I will coalesce around some of the themes that are emerging in the questions that are coming through, with the first one being rather philosophical, perhaps. And I may direct this to to Decio first, if I may. We were talking philosophy before, so maybe well timed. How do we come up with the notion of what is good and what's bad? So just to trip you up with that one, if you could articulate that for us, that'd be wonderful.
I don't think I could. My philosophy endeavors are more analytical philosophy, maybe philosophy of language, philosophy of knowledge. Moral philosophy is it's above my pay grade. But Eddie, if I may just go back to what I said before, if we decide that good is what most people think it's good and bad is what most people think it's bad, right? So you use almost the zeitgeist of society to tell you, and this is going to change with time, right? There are things that we thought was good in the past and we disagree with today. Then you can probably use a democracy that's more direct and less representative and more dynamic, more instantaneous with technology. But that is as far as I can answer.
That's true. So it's a bit unfair of me to send that your way first.
Stop worrying you were looking at you.
Yeah, that's right. That's right. Well, there's a very similar question, of course, that you'll see on the in the app if we've been posing questions, and perhaps peripherally somewhat similar. But let me pose this to the panel, and I'm very happy for anyone to respond to this particular question. Can there be trust in fintech that doesn't center on purpose? If so, does that destabilize purpose as a foundational consideration? So can there be trust in fintech that doesn't center on purpose?
Yes. So I think that at the end of the day, trust is, it's not given, it's earned. And so purpose or otherwise, in many communities, finance hasn't earned trust at the moment. And the way to do that, whether you align it with purpose or not, is through the process of transparency, inclusion, and concepts like that, co-designing, bringing people in who maybe haven't been involved before. So, looking at your different community groups, solo parents, rangatahi, the Māori and Pasifika communities, et cetera, so that you are building, as I said before, with people, not for people. And alongside that, I would say that in fintech, data is power, but it does come with a high degree of responsibility hand in hand with that. So trust for data is not a compliance checkbox. It's actually a cultural choice, I think. And the biggest risk is not only the technical risk of breaches of data, but in building products that embed bias that already exists, digitizing that to make the bias actually happen faster than it already was. So it's really about the safeguards of going beyond privacy and compliance and into cultural competence, into data use and power sharing. And as to whether you decide to put those things under an umbrella of a company's purpose or not, they could be really quite independent, I think.
Yes. Sorry, there was a nut over here.
Yeah, I have a nut. This is an academic viewpoint. It's like a two-handed economist. On the one hand, on the other hand, you always have constants for everything. But I'm going to say there is always a purpose for finance, right? The purpose may not be what you agree with. That's a totally different question. But every financial product has a purpose: making money, doing good, whatever. So what is this going back to that first question? What is good and what's bad? That's a really complicated question as well, because going to moral philosophy, there are actually two important approaches which are relevant here. One's called a deontological approach, and the other is basically utilitarianism. The first one basically says that some things are just bad. You cannot do them. Like murdering somebody is terrible. The second one says, well, if it benefits the greatest good for the greatest number of people, that's the right thing to do. So you can push someone onto a trolley tracks if killing him will save 5 other people. But what happens if that one guy is, a genius like Albert Einstein? You have all these moral philosophy questions. There has not been an answer to any of these questions. Nobody knows what's right or what's wrong. But that's, again, going back to this year's point, a thing for society to decide. What is marginal? What do we owe other people? That is something we need to decide together. If you come up, in some societies, you come up with a question, everyone is in it for themselves. Like the US, for example. I don't have to do anything that benefits anybody else because we're all individualistic and we all carry cars.
Now, Andrew, that is true. I was presenting in Texas once, and I see people in the audience with guns on their hips, and I'm a little worried.
But on the other hand, you have other collective societies like Japan, where you don't think of yourself so much, but what matters for society. So the answer to the question actually depends on what is the problem you're trying to solve. If you're trying to solve a problem which involves collaborating with other people, that would work in some societies, but will not work in other societies. So it goes back, I think, to Decio's point. It's what we decide at the end, what should be the right thing to do.
Well, if I may, I'll focus on to your segue to ethical behavior and perhaps ethical decision-making. There was a question about crypto. And so if I may, Chanelle, I'll point this in your direction at first. The crypto market was described as lawless. What's so bad about it? And can this be seen in a good light? And very similar thematically, of course, to another question. Is there any use of crypto that is ethical and genuinely value creating? So, lawlessness or opportunity?
Yeah, a few questions in there. So on the lawlessness point, crypto, something that's very fascinating about this system is that it sits beyond any jurisdiction. So we're still struggling with the legality of a lot of issues that have come up in that space. And I'll leave that to all the legal folks in the room to comment on that. But in terms of the crime in crypto, as Chris has mentioned, it's rife. Crypto has been used for money laundering all over the world because it's pseudonymous, which means that we can trace the flow of these funds all over the place, and we can even identify particular wallets and how much are in these wallets at any given time. We don't have a tie or a mapping from those wallets to the legal people behind them. And so that makes it very challenging for us to operate within our traditional legal frameworks. In terms of, and never mind all the scams and everything that go on, because these are new. This is a very new space. A lot of people don't understand the technology, and that always makes you more susceptible to crime. But in terms of it being used for good, I have some optimism, and in some use cases, I very much think that it needs to be brought within the regulatory net before we really see some of these benefits coming into play. But I think tokenization of assets could potentially unlock credit opportunities to people who are otherwise left out of the financial system. So that can promote financial inclusion. I'm from South Africa, and I hear stories of banks developing and offering stable coins and really trying to extend financial services to the unbanked population. In New Zealand, we have 1.5% of New Zealanders are unbanked. That's about 50,000 people. So it can bring more people into all the benefits that we've spoken about in terms of what financial products can do.
Becki, has this been your experience also?
As quick add there, and if I'm correct, I believe that in New Zealand, the number of unbanked has doubled since 2014. So it is a growing problem here for us. I think that is a different trend line to what we see globally. So certainly something to consider going forward. But just wanted to pick up actually on kind of cryptocurrency and the lawlessness of it, from our world in tax. This has been a feature of many a discussion and debate, but the law is catching up. And actually, we have started to see increasing numbers of voluntary disclosures and therefore reassessment purchases coming through as a result of what was previously undeclared earnings there. The government's data connectivity is getting better, and they are becoming able to track down to the taxpayer level and contact them and say, hey, we understand that you have this amount of money in your wallet, but you are currently not declaring income. So it's catching up at least a little in that regard.
You feel like the regulatory environment, Chris, is also catching up, or it's
Yes.
in short doesn't want to catch up?
It is miles behind. And so people have asked the question, do you think it's fair that 500 or so people made money out of the Trump and Melania coin and 746,000 people lost money? I mean, that is, to me, not fair. And so regulation is we've been talking about this for a while. It's a long way behind. And as I said before, Trump, the SEC is meant to be a world leading regulator, right? And in many areas of securities law, they have been, but they are nowhere on this front now, and taken an even bigger step back under the current president. So when you have the major financial market in the world, the deepest capital markets in the world, listed companies that are now on the S&P 500, Coinbase, that are now in everyone's 401k, pension funds all over the world, and operating and trading in products that don't have proper regulation for financial instruments. Now, in New Zealand, we can catch you under the fair dealing provisions of the Financial Markets Conduct Act, but it's hard work. And so, you need these things to be on regulated exchanges with some railway tracks. I'm all for innovation. I'm not trying to stifle innovation. I want people to knock themselves out on financial market innovation and financial product innovation. But we need to sort this out, because those that are losing money are the people that can least afford the money. You have to remember this. The people that are gambling, they are speculating, are the people that can least afford it, because they are taking huge risks to try and uplift themselves. So these are the people that can least afford to do it. And so we're making our societal and social problems even worse by allowing this to happen.
But the 500 people who made money on the Trump and Melania coin, as opposed to the 700,000 people who lost money, do we owe them anything? I mean, they're idiots. So would we say, okay, you know what? If anyone thought they were going to make money with the Trump and Melania coin, they had to be deluded in some way. So what's the responsibility if someone says, I'm going to burn my own money? The money.
I think it was more around the timing of the issuance as well. It was I don't know the exact details, but it was a timing thing of and these guys just hoovered it up and were able to turn it around very quickly. I am with you. I mean, you cannot save people from themselves.
Exactly.
I mean, but we also do need strong insider trading rules, which we have in listed securities markets. And these are listed securities. They are now trading on exchanges all over the world. I see Binance bag there, probably a bad example of the exchange. But it needs, what was the failure there? Money laundering, clear, but a lack of regulation, and on a global scale.
So my question is, we're talking about regulated markets. That means that opportunities are already on the road of success. So we Kiwis are innovators, and so three guys in a garage look at what everybody else in the world is doing and go, where they're going to be in 5 years, why don't we do it now? And that's what we do. So there is a deregulated market of raising capital to start up businesses, whether it's bootstrapping or whatever. Okay. And what I'm seeing is that for me to be able to officially sell as an investment bank or a digital securities company, our shares even in a startup and a seed round and a growth capital basis, okay, that the FMA, I have to get FMA approvals. So how do we break that? How do we support our innovators here? We're one of the most innovative countries in the world per capita.
You don't have to get FMA approvals, let's be clear. What you have to do is make disclosures to a certain class of investor, right? And so they have to be a sophisticated investor, and we have the wholesale investment regime, and you have to be meet the requirements under the wholesale investor test or the eligible investor test, which we are currently before the courts seeking clarification of.
But to be able to do that blockchains where their units of value that they're purchasing or investing or leaning against.
There's nothing to stopping you using a blockchain register. I mean, it all comes back to disclosure, and are the investors that you're taking money off, are they appropriately qualified to assess the risks? Right. That is clearly laid out in law, and it is on you, the person raising the capital, to ensure that the people are either getting appropriate financial advice, meet the tests, or the people meet the tests in their own right and can make a capable decision.
So therefore,
so there is nothing roadblocking you.
Well, we're getting to the pointy end, and what I might do is I might invite you to consider for the next session, which we're getting into what I've entitled Tools, Trust, and What It Takes. It sounds a little bit like, at least that's where the conversation's going. So perhaps I might invite you to consider the next session, of which we'll kick off now. Again, block 2. Now we're getting down into perhaps the more tactical end or edge of things. And if I may, I'll start with you, Chanelle. You mentioned the unbanked, which is a fascinating topic I know you've done some work on before now. And you've talked about how trust in fintech isn't just technical, but it's deeply social. What do you think fintechs need to get right if they want to build real trust with people who've been left out of the system, these unbanked? What do you think the fintechs need to get right?
I mean, I think it gets back into the conversation that's just been going on where as I'm all for innovation, like Chris as well. But I think that fintechs also need to understand that getting back to Becki's point on purpose and who you're building the products for and with, that a lot of the innovation in fintech has unlocked a customer base who are potentially less financially and digitally literate than a lot of the traditional financial world cater to. And so I would say the responsibility is partly on the general public we all should upskill and be open to these tools, explore them, work on our own financial and digital literacy, because that makes us resilient against cybercrime. But it's also on these fintechs to put effort into understanding the regulatory environment and work with the regulators. So, for example, the banks that are developing and issuing stablecoins have formed this consortium. It's an R3 consortium, a global collaboration across private industry to work with regulators to understand how these kinds of small initiatives can be scaled up onto a much.
You're talking about a sandbox and stuff like that. Yeah.
So effectively making sure that the same, perhaps legacy gaps don't emerge within this new sector. So
Exactly. I'm actually going to go back now to 1977. There was a paper written by a guy called Kevin Rock, which was actually written about initial public offerings, but sort of very relevant to this discussion over here, because his question was, what happens if, initial public offerings are not regulated? And so the question goes back, why is regulation important? And the answer there was, you end up with a bunch of sophisticated people who know what the good opportunities are, and they go in and they grab 100%, or they grab, let's say, 50% of the good opportunities. But the unsophisticated people You get 100% of the bad opportunities because the good guys are passing up those opportunities. So the unsophisticated people, however, are not stupid. They know they're actually being, they're getting shut out of all the good opportunities. So they simply do not participate, which goes back to Chanelle's point about the unbanked, right? Why am I unbanked? Because I don't trust the system. Why do I not trust the system? Because I think it's being governed for the benefit of somebody else. So that's why, in a way, you need regulation. It's not because regulation itself serves a purpose. It's to tell people that regardless of your level of expertise, you go in, you're not going to be discriminated against, and therefore you don't leave the system. Because once you leave the system, then the entire system of finance collapses. That forward transfer of money I talked about in the beginning, no one's transferring money across time because I don't trust the people right next to me. So the money's never going to go forward in the future.
And where did crypto come from? Of course, was distrust in the system. Exactly. But just on the unbanked, while I hear you, there are some people that just check out and they don't want to participate. I fear a greater proportion of the unbanked in New Zealand now are those that are really less fortunate and are suffering like societal exclusion on a whole lot of levels, and that is because our social safety net and frameworks are actually failing down there, and I think you can see that in the mental health system and right across the board. So I actually think it's a little bit more of an issue in New Zealand and frankly all around the world. You could see it. You brought up America. I was just there. I mean, you can see that on the road of any freeway or get off at a junction, and it's a pretty horrible sight. And so I think that's where a lot of unbanked is coming from as well. And that's something we're going to have to deal with. That's, there was great show on RNZ this week of a guy who had built up a building company, but was explaining when he came out of prison, and he said, I deserved to be in prison when I was a young guy. I was off the rails. But when I came out, there was nothing for me. Didn't even have a bank account. And so there's nothing. They gave him $350 kind of thing. It was eye-opening when you heard it.
Yeah, there was a question that we didn't get time to cover in the previous block around sort of how do we build dignity into the system and strengthen trust in the system, in some cases around an aversion to the system that could in fact help in that case. But again, to allude to one of your points, Chris, having worked closely with the FMA on strengthening trust in our markets, what have we or you learned that good fintech looks like, I suppose, and what do we need to look out for?
Well, fintech is hard. I mean, it's that's kind of just picking on one. I mean, we'll probably be able to talk to this a bit better because we've just set up a sandbox. I mean, what works well across the financial services sector and fintech included is, as I said, a clear framework, and people know where they stand. That's as a participant in offering a product, and as a customer or a consumer purchasing that product, be it insurance, banking, some other financial service. And so, fintech's a new catchphrase, and the mayor's hot on it, and I was down there helping him out this week and talking about fintech and developing, and it's the new catchphrase for the next 10 years in our economy, and all power to everyone driving it. But at the end of the day, fintech just fits in with every other traditional financial service that is offered in the marketplace today. You need very clear railway tracks and a regulator that regulates according to the laws and provides clear frameworks. And when you fall outside of them, everyone knows, consumers and participants knows, you're going to get a hard slap. And that's how it should be. And then it goes to court, and then a group of your peers, and as society changes over time, they will adjust how they see those penalties should be administered. The system actually works if we just stick to some pretty pretty basic.
You talked a little bit about this too, Decio. You've written some work on the need for clearer boundaries and better long-term thinking on fintech specifically. What do you think that is one thing we could do, either a policy or practice that would help build more trust and stability into the system, do you think?
I think this links a little bit in the previous questions, which is financial literacy. And it's a bit surprising if you think about it, that around the world, you're now learning about finance, economics, and law, right? I saw something about New Zealand passing this, where you will start learning about the economics or finance in high school, but in most places that's not the case, right? So a lot of the times we are using a market mindset to think about allocation of capital. Like Professor Raghu said, why should we care about the 700 that don't know what they're doing? And you compare with that 500. But what if the gap is financial knowledge, right? And if it is, then technology nowadays can bridge that gap. Another example is qualified investors, be able to invest in private equity, venture capital, hedge funds, by account for hedge funds. And I always thought that was a bit unfair, because that's where the best returns are. So that right public should be invested. And why is the government having to step in on regulating that instead of providing financial education to let people make their choices, right? There's no excuse given the technology that we have nowadays. So I think it goes back to financial literacy. You can't stop this explosion of information we had in the past 30 years with the internet. It just grows faster and higher AI and access to everything. And people see that, right? So if you think about going back to philosophy real quick, Thomas Kuhn says, right, you're going to fix on a paradigm to be able to push the boundaries of this paradigm, and then you have to shift that paradigm, right? So you have Newtonian physics, you do all the work you can do in that field, and then things start not working quite well at very small spaces or very large spaces. So Einstein comes in and you got to readapt. And I think what we're seeing today across the world, emerging markets, developed markets, is this clash where the technology evolved and institutions didn't. And then products like crypto appear and they show the flaw in that system, right? All those systems are created by fallible people, right? And they all have failures. And we're stressing those failures. And that's where you end up having some form of change. But how do you do intelligence? Good change is, when you are able to spread the knowledge around. So I'm an optimist. I think we'll get to a point where most people have a level playing field. And then, yes, then the people that are more lazy might not benefit as much as the people that are hard workers, but the initial conditions are not that different.
So you talked a little bit about this, Becki, already. So you're at the front end of this. You alluded to technology as perhaps democratizing access to that information, to financial literacy being a big part of that, but hard making trust and transparency into your products. How do you ensure that continues to happen at the pace of innovation?
Hey, look, the first thing I actually want to pick up on is building on the financial literacy point, if that's okay. I don't know how many people in the room here know what the average financial literacy is in New Zealand, but last time I looked into it, the average New Zealander has financial literacy of like a 9-year-old, something like that. So, it is kind of all well and good for us to sit here and watch people make really dumb financial decisions and think, is it for us to save them? But kind of picking up on your point earlier, actually, finance sits in an ecosystem. And if the ecosystem is failing, in many ways, I would argue we have a duty of care to those people. They do not have the tools to engage properly. So that was just the first point that I wanted to land. The second one is I kind of want to offer an alternative perspective on innovation and regulation. I think that sometimes we assume that innovation means something outside of the existing regulation. And, there's a lot of merit in that. But as we're finding, it is, policy and law are slow to respond. Of course, slower than the innovation is. And things like policy can be a blunt instrument. It can be super useful, but it can also be a little bit blunt, can have unintended consequences. So I like actually to challenge sometimes to say, what innovation can we do within the boundaries that already exist? And for us at Tax Traders, perhaps tax is an example of that. We didn't need a law change or a policy change to create new gross capital to form that here in New Zealand. There was $18 billion of capital sits idle and then revenue for about 18 months before taxes are finalised. The money's sitting there gathering dust in a bank account and it's doing nothing. It's not productive at all. And the answer to that was sitting right in front of us. Really big corporates who are transacting big sums of tax had for years been able to make that tax work for them. But it was previously quite elitist and quite expensive. You needed to have specialist technical knowledge, really expensive accountants and even lawyers to an extent. And so in the first big lockdown, where one of the biggest NZX-listed companies in New Zealand come to us and say, hey, I paid you $30 million of tax to you recently. Can I please have it back? Because I need the working capital to get us through this pressure. And we thought, man, every business in New Zealand must need this right now. Why is it that only the very biggest corporate companies can access the benefit that actually exists already in our tax system? And so that led us down a path of 2 years of angst and work to productize it. And now businesses who are compliant and profitable and paying their tax on time to us and the tax pool to Tax Traders can use that as an asset. And we can provide them with working capital at about half the rate of a big bank overdraft. So that is an example of innovation that's estimated to deliver, population grade GDP benefit that has been done within an existing law and regulatory framework, has not needed any law change, it's not needed any new regulation.
Innovation within the railway.
Within it's just possible. I've actually completely forgotten what your original question was, but I think I've spoken for long enough.
Well, it's a good preface to our next discussion session. And again, as you are already familiar from the last block, 5 minutes, please. Yes. Oh, is there a question in the room?
But you're emphasizing regulation a lot. I mean, on fintech, a decade or two ago, they gave Peter Thiel New Zealand citizenship. He was wildly enthusiastic about the country. Now, from what I understand, he's gone off it completely. They rejected his house in Wanaka because they said it wasn't aesthetic enough. And he loved the kind of no-ring light regulation. And in Queenstown, if you do bungee jump, and no one would sue you. So it wasn't like America before. But now his group, they've abandoned New Zealand, and these people are libertarians. They hate government, and is the whole settings in this country, in a way, a turnoff to Thiel and all his fintech crowd. Does that mean we're never going to be in the forefront of essentially any action?
Robert, look. When I say railway tracks, I mean, what do regulators always do, and bureaucrats? They always over-regulate in the end, and so you have to have a mechanism to pull it back. But we do need frameworks. I mean, Alex Carpin and Peter Thiel are a little, they're right out there on the spectrum of terms of their views of regulation. Very successful businessmen, but at the end of the day, we've got to deal with a whole society and a cross section and a broad cross section of people. And Thiel's famous line is, if you find competition, you're a loser. he has a different view. He has a very different view of the world. But I hear your point. And, at the FMA, there's 21 pieces of regulation that touch us. I mean, that is simply ridiculous, right? And that should be consolidated down to 3 or 5 bits of regulation. So as with any system, it gets taken too far over time. But there are critical railway tracks around capital markets that you want around IPOs, around secondary offerings, that you want in place to protect investors of all shapes and sizes.
Now, I'll introduce the one question that had the most upvotes, and this will serve as our final question. We've enjoyed a great deal of conversation already, so we've got one question that we'll end on before I close, 7:30 being the time that we're due to finish. So again, I'll pose this to the entire panel, and it really circles around a couple of the questions thematically that the room has posed. The very first one being, or rather the higher level theme, I suppose, represented in this question to the panel. As the expansion of financial products continues, does anyone hold responsibility to educate the public? And if so, who? So whose role is it to educate the public?
So really simple answer is the issuer of the product.
Yeah.
Is you shouldn't be issuing anything without an explanation of what it is there to do, how it is meant to help you, what are the risks around it. And I personally think that's on a wholesale and a retail level. It's the wholesale isn't as strict a requirement, but if it's a retail product, the onus is on you to ensure that product is clearly explained, disclosed, and if so we avoid all of the bad things that have happened in the past, and we need to learn from the mistakes in the past. So it's really simple. That is the answer. There are no further debate.
What a good way. What a good place to really express. Well, I'm conscious of the time. Again, I am loath to stop the discussion. We've got a great deal of questions that, if I may, pose to participants that I can send through to the panelists, if I may, and if they wish to respond to the questions directly, then we can find a way to distribute the answers in some way, shape, or form to participants. So thank you for engaging with Yat. This has worked rather well, I think, and it's given us an opportunity to engage more with the panel, perhaps in this design that we're still developing. So, yes,
I guess quick. I think there is one thing my contribution in.
Well, the basis, I'm very happy to after.
Less than a minute.
Less than a minute. I'm going to hold you to it.
All right. A Nobel Prize on Inclusive Capitalism was given to Muhammad Yunus for Grameen Bank. Question to Chanelle and others: is the Grameen Bank an innovative tool for building trust and inclusive capitalism because it relies on PR monitoring?
Sorry, I didn't catch the end of the question. Which bank?
The PR monitoring. So trust. To build trust, Grameen Bank relies on PR monitoring. The follow-up is the big banks are bad, small is beautiful. Is it correct?
I would say it's a horrible cop-out, but it depends very much. But I think peer effects and peer monitoring can be very useful and helpful, especially in environments where they're on the edge of the regulatory remit, and a lot of traditional credit involved peer monitoring. And so if we go all the way back to before we had such advanced institutions, so I think that an element of that will always continue, but it must sit amongst the formal regulation. I don't know if you want to add something.
Yeah, actually, it's not small versus large in this particular case, right? The key problem for a bank is, will I get my money back? So usually with larger banks, the way to get their money back is they hire people, loan officers who go after you, check the papers and so on. Grameen's innovation was simple. They had the neighbors monitoring each other. So basically, you don't have to do it yourself. You have your neighbors who know better than the bank officers what you're spending your money on.
So is it good to emulate here?
In that case, in this particular case, it can lead to negative consequences too, because your neighbors are now constantly in your business saying, what the hell are you doing? Why are you having a loss of beer? And you should be paying the money back to the bank because, second innovation was if any one of them doesn't pay back the money, nobody gets another loan from the bank, right? It's all peer pressure, as Chanelle points out. The third thing, of course, was they mostly lend to women because men are totally untrustworthy. So.
Well, that's a profound. How quickly we've all forgot too big to fail. Which is that's the problem with that.
Very good. Well, thank you again very much to our participants as much as our panelists. Will you please join me in thanking